So we've still got quite a few trading days to go. This isn't going to do much damage. It might be healthy. I know everybody hates it when I say stuff like that, but if it could pull back and retest this resistance here, and if that becomes support, it is like confirmation that the game is on, that this is a bull market that is going to last longer than just some flash in the pan that's going to happen between now and late January. This is going to be much longer, and we are going to be seeing triple-digit silver.
As we head into 2026, two longtime silver watchers, Mike Maloney and Michael Oliver, are arriving at the same conclusion from very different angles, and it's one that's getting harder to ignore. The silver market, structurally, looks primed for a major repricing. At this point, the real question isn't if it happens, but when. Yes, silver and gold have both pulled back recently, and that sparked the usual debates about paper market pressure and short-term manipulation. But neither Maloney nor Oliver sees these moves as a warning sign. In fact, they see them as the opposite, a brief release of pressure inside a much larger bullish setup that remains firmly intact going into the new year. Volatility, in their view, doesn't change the direction of the trend. It's part of the process. What we're seeing right now, they argue, isn't real weakness. It's the result of positioning, leverage, and short-term liquidity shifts in the futures market, a market that has become increasingly detached from what's happening in the physical silver supply underneath it. Looking ahead to 2026, both analysts believe silver is approaching a phase where price discovery starts to move much faster. Once key technical and psychological levels are broken, higher prices could follow far more quickly than most expect. In that context, even triple-digit silver is no longer treated as a wild theory, but as a realistic possibility within this cycle. And this isn't just about price targets. Maloney and Oliver are also pointing to bigger forces building in the background: fragile government balance sheets, tightening physical supply, and a growing gap between paper prices and real-world availability. These pressures matter, because when confidence shifts, capital moves fast. In this video, we'll break down how Mike Maloney views these developments through the lens of monetary history, and how Michael Oliver's technical work suggests silver may be approaching a critical turning point, or in his words, a new reality. And if you value deep data-driven analysis like this, be sure to like the video, subscribe to the channel, and turn on notifications so you don't miss what's coming next. We appreciate the support and hope you enjoy the video.
Just a couple of hours ago, I got an email from Nick Laird at Gold Charts R Us. The CME has raised margin requirements yet again, up 9.1% on gold. Silver up 30% from $25,000 to $32,500 for each 5,000-ounce silver futures contract. That's the cost of maintenance. And so here is the letter, and if we jump down to page 4, we've got the 5,000-ounce silver futures contract, and there is the current maintenance, and this is what is now required. So anybody that has a contract has to come up with an extra $7,500, and if they've got a lot of contracts, that can add up to some serious cash, and that means that they may have to sell some of their position to come up with that cash. And if they sell some of their position, the price of silver goes down, which means that more people run into maintenance requirements, and it becomes difficult. So I am expecting that when the markets open, silver is going to fall. But to me, that's a buying opportunity. Now, I don't give any financial advice. I tell you how I feel about it. I think that things have been getting overbought, and this, it is not irrational exuberance. This is fundamentals that are playing out, and that is the reason that silver is rising. Some people think that it's just speculation, but it isn't. It's rising because of supply-demand fundamentals and all of the future need for silver. And so what I did was I made you a chart of what silver might be doing shortly. Now, every once in a while, everything needs to take a little bit of a rest. when we were in the initial phase of this bull market from 2002 until 2011, I used to say whenever gold comes back and touches the 200-day moving average, it's time to buy. The 200-day moving average was something that was a really good area of support. This is the 9-day exponential moving average, the 20-day simple moving average, and the 50-day. The 200-day doesn't show up on this chart. It's just off the bottom of this chart. Now, I'm not expecting silver in the conditions that are happening right now. I'm not expecting silver to do a pullback down to the 200-day moving average. It didn't back in the 70s it was actually, I made a video on this day right here back in November, at the end of November. I was wondering if silver was going to punch through this resistance at 54 something. I think it's like 54.80 or 54.60 something. If it was going to punch through that resistance, and I was comparing it to charts that I had made of the 70s, and it was the same calendar day that silver finally broke through its resistance in the 1970s. And I can't remember what the price was, but it did some just amazing performance down in the tens or something like that, or maybe it was down at 7. I can't remember. You'll have to go back and watch that video at the end of November to see what I'm talking about. But it did break through that resistance on the same day and start a spectacular run-up just like it did back in the 70s. This is pretty much a reflection of what happened in late 1979. So I found that very interesting. So I don't believe that it pulled back to its 200-day, maybe not even its 50-day, between then and I believe it was January 19th, where it put in its high. So we've still got quite a few trading days to go. This isn't going to do much damage. It might be healthy. I know everybody hates it when I say stuff like that, but if it could pull back and retest this resistance here, and if that becomes support, it is like confirmation that the game is on, that this is a bull market that is going to last longer than just some flash in the pan that's going to happen between now and late January. This is going to be much longer, and we are going to be seeing triple-digit silver, but this was so overbought, and it had happened so fast that it's good that it's pulling back. It's bad that it's pulling back because of manipulation. And the way the math works out and everything, they are always protecting the shorts and hurting the longs on these. And so just don't get involved with futures contracts. Just, physical silver has enough leverage all on its own, and we've seen that in this big move from the low 50s up into the 80s in just a month's time.
Maloney's core point is simple but powerful. Silver's long-term underperformance hasn't been a coincidence. It's been structural. For decades, heavy paper trading, derivative leverage, and policy-driven distortions have kept true price discovery in check, even as silver's role as both money and a critical industrial metal has continued to grow. Maloney also points to a familiar pattern that shows up again and again in this market. Sharp corrections aren't random. They're often used to shake out weak hands, clear speculative excess, and reinforce the idea that silver is too risky or unreliable. But once that process runs its course, the fundamentals tend to reassert themselves, and when they do, they often do so with even greater force. He also highlights something crucial about how silver behaves when confidence in the system starts to crack. Gold usually moves first, pulling in institutional capital early. Silver, on the other hand, often lags, and then suddenly accelerates when monetary stress becomes impossible to ignore. That dynamic is what brings us to Michael Oliver. Oliver approaches the market from a very different angle. He strips away the narrative and focuses on momentum, structure, and what price action is quietly signaling beneath the surface. And as we transition into his analysis, it becomes clear why silver's current technical setup isn't just encouraging. It closely resembles past moments that came right before some of silver's most explosive upside moves.
So let's get into it. What is your take for 2026? And are you concerned at all with these moves that we've seen? Concerned in the sense that we might get a pullback?
I think you had the pullback. Okay. Silver is in an acceleration mode. It's not in a normal uptrend mode. So if one applies the normal technical metrics that say overbought, for example, ignore them. We're not in a normal market. A normal market meaning a normal bull market, that goes up in layers, or a trading range market that gets excesses both ways. Silver is in a seeking a new reality market is what the phrase we use. It's going into a new reality, and it's going to do it suddenly. Meaning, by our metrics, not judging the silver by its own dynamics, but the silver versus gold situation, which a lot of people plot the other way, the ratio. We divide silver into gold and express the answer as a percent. And back early this year, it was down to 1%, silver ounce versus an ounce of gold, which if you go back 50 years, you see times when it's that low, you buy it because it's too low in relation to gold. In the 1979 to 80 move, which everybody remembers, that's when silver went actually from, it had been in a low around $3 or $4 and went to 50 over a couple of years. A lot of that compressed in the last couple quarters. In fact, a fourfold increase in the final 2 quarters of that move. And in 2001 through 2011, there was another bull market, but a lot of it was compressed in a couple quarters in September 2010 through April 2011, where several doubled in a half in 5 months. Okay. But those were within that old range of reality. It's half a century of this. Okay. You've got some charts if you want to show them, but there have been other markets that over history, rare events, admittedly, but have been stuck in price ranges. Copper's one, lead's another we've shown to our subscribers. Back in, this is just a good historical example. Copper was stuck in a range like silver between the 1970s, 80s, 90s, 2000, and 2005. The top of that range was about $1.50. Okay. And it suddenly decided, for whatever reason, unique to itself, because it did it on its own. It was not coincident with gold. It was not coincident with other base metals. Copper quadrupled in a couple quarters. And then subsequent to that, it overshot, it's no new normality, but it moved out of the old multi-decade range and did it like bam, not in an incremental layered manner. Lead did the same thing in 2007. It had been in like a 40-year range, and it said, oh, okay, I shouldn't have been here that long. I'm priced too low relative to, let's say, degradation of the money unit. So it did the same thing. It quadrupled in a couple quarters in 2007, and then subsequently lived in a new price reality that was roughly 4 times the price level of that average old price reality. Okay. Well, silver's been in that reality for 50 years. Why didn't silver coincident with copper in 2007? Or 2005, or lead in 2007, or gold in its repeated 8-fold bull markets, goes well past the old high. And yet silver stays in the box. What's going on there? Well, there's arguments that, it's been artificially restrained and so forth. But forgetting that, when a market decides to say, hey, I made a mistake, it quite often will compensate for the mistake by repricing itself rapidly. This is true with like bull market bubble tops, like in the stock market. Sometimes it crashes, okay? It compensates for it and overdoes it. Well, silver's saying, hey, I'm out of here. And the momentum already said that back in June. We said, okay, when silver was coming up toward that mid $30 level, it'd been 35 and 35 in 2024 and 2025 early. And silver dropped down under 30 again, and it's coming back up in June of this year. And it was in the mid 30s, and we said, this time it's different. You're going to accelerate. And that was a momentum-based assessment, not just that price looked good. And sure enough, it zoomed past 35 and got up, up toward the old range highs, the $50 stuff. And now we've since blown that out. But its mode of advancement has accelerated, like you noted, the year to date. Few people are cheering that. They're screaming at every downturn. The difference this time is the silver gold ratio just broke out of a massive technical basing range where silver had been caught in a box since the early, like 2022, 2023, 2024. It kept coming back up to like 1.2 something percent of gold and go back down. So you could see it on a spread chart, which we've also sent to you. And when it broke out, that was the November close. And silver then was what, 44, you said, something like that? Yeah, where we last talked. Okay. Well, look what happened since. The month of December, you went, well, I think the November price close was in the mid 50s. So we gained, 10, 20, 30% in a matter of 4 weeks. What caused that? The spread broke out. And when you go back and look at that 79 explosion to 1980, where you quadrupled in 6-7 months, or the 2010 to 11 explosion, already in a bull market, but it exploded. Those lasted a couple quarters. We just broke out into November. So this clock is very young, and people aren't understanding that something different is going on.
Let's talk about the silver gold ratio. And if you just look at that, where do you see it going? Where do you see the price of silver going here in the coming
Well, in
months?
50 years, going back to 75, if you plotted the highest monthly spread close of silver to gold, the monthly close during that year, that was the peak reading of the ratio, the difference between silver and gold. 20 of those years was 2% at least. 20 out of 50. So that's not like rare. In fact, a lot of those occurred in non-bull market years. But in the bull market years, 79 to 80, the tail end of those explosive moves, and 2010-11, it got up to 6.5 and just over 3%. So we're in a bull market now. We've broken out on the spread. So I don't think we're just going to 2%, which is, who cares? That's normal. But we're at least going to match the old spread highs of those prior bull markets. Heck, we've taken out the price highs of those markets. Why not the ratio highs? And I think we will. My minimum assumption, and this is now minimum, is that silver will at least see 200 in the next 6 months. Okay? Now that sounds crazy. Well, again, when you look at that copper chart, it went from like a range from 50 cents to $1.50, and all of a sudden went up to 4.50 in a couple quarters, and it was unique to copper. These kind of things happen. And I could have found 6 other markets that did the same thing over the past 50 years. Silver's doing its thing now. And we all know that this time around it has unique factors that are underlying this, but most people forget the real factor. Yeah, we have a supply-demand deficit, and we now have demand for silver that is outpacing supply based on high-tech things, solar power for the solar panels, and also all the tech and AI constructions that are going on. Silver is essential in that. It's embedded in everything you touch, okay? Maybe a small amount, but it's an essential. And that demand is eating up the supply, and supply is not increasing despite the higher price. So you got a unique situation there just on that industrial aspect of silver. But the underlying reality is it's money. Don't forget that. It's poor man's gold. It's going to catch up to gold. It's going to catch up to its old relationships to gold. And in the process, that's an incredible price implication. And I think it may even challenge the spread highs we saw in 1979-80, 6%. Again, we're 1.6 right now, okay? And take out the 2011 peak, which was 3.1, I think. So those are factors that are underlying. So silver's like a surfer riding on waves. And the top wave everybody chatters about. It's just the day-to-day, they raise margins on the COMEX or this, that, or the other, micro stuff that doesn't matter. It's the ongoing supply demand, not whether the COMEX raised margins by 5, 10%, 5, 10%, 5, 10%. That's not important. The fundamentals are still there.
Oliver's research shows that silver's long-term momentum is finally breaking out of a range that has held it down for decades. These aren't small technical shifts. They're the kind of regime changes that tend to develop quietly and then suddenly show up all at once. When silver moves from a corrective phase into an impulsive one, the price action is rarely calm or orderly. It usually reflects a market rushing to reprice an asset that's been undervalued for far longer than most people realize. When you layer Mike Maloney's macro view on top of Oliver's technical framework, the picture starts to come together. Monetary debasement supplies the fuel, and momentum provides the spark. Rising debt, ongoing deficits, and fading confidence in central banks create the backdrop. Against that backdrop, silver's scarcity becomes harder to ignore. At the same time, industrial demand, especially from energy transition technologies, continues to tighten supply in ways the paper market can't hide forever. That combination is why, once silver breaks through certain levels, higher prices may be driven less by speculation and more by necessity. It also helps to step back and look at silver's role within the broader precious metals market. Gold remains the foundation of monetary confidence. Silver, however, carries a dual role, both monetary and industrial, and that makes it more reactive. Historically, once gold signals deeper stress in the system, silver tends to respond with leverage. That's when silver has often gone on to dramatically outperform, not because it's more stable, but because it's more constrained. With inventories already tight and new supply slow to come online, price becomes the only mechanism left to resolve the imbalance. The key point here isn't that volatility disappears. It doesn't. What changes is its character. Pullbacks become shorter, dips are absorbed more quickly, and old resistance levels start to matter less once momentum takes control. Focusing only on short-term price moves risks missing the larger realignment happening underneath the surface. Both Maloney and Oliver are essentially making the case that 2026 isn't about catching every swing. It's about recognizing that the market's tolerance for silver being mispriced is rapidly shrinking. As we move forward, the big takeaway is alignment. Macro forces, technical momentum, and real-world supply and demand are no longer working against each other. They're reinforcing one another. That doesn't mean the path will be smooth, but it does suggest the balance of risk has shifted meaningfully toward higher prices. If you found this breakdown useful, consider liking this video and subscribing to the channel for more deep dives into precious metals and the macro landscape. Thanks for watching and for spending your time with us.